All right, let's try this again. Obviously, Brett Comcast must know we know something big and wanted to cut us off because my internet literally went down right when I started talking. Hopefully, we should be in good hands at this point. So, without any further ado, want to welcome everybody to the latest edition of the Sentiment and Flow Show, and that is, of course, myself, Gavin McGuire, event trader, and I am being joined by the one, the only Brett Manning, chart trader. Brett, how are you doing today?
Pretty good, and I think I'm the only one. So
You think you're the only one? What?
I mean, chart trader. I think I'm the only one. You said the one and the only. I'm just saying I can't
I don't know
verify
chart
that's
trader.
absolutely the case.
Oh my
So,
God, they're running all over the neighborhood. These chart trader guys.
well,
So,
I'm just saying, I can't verify it for sure, but I'm pretty sure.
cheap knockoffs, no doubt, Brett. Before we get started, you took a trade in the Dow that started working in your direction, got that nice drop there. Now we're seeing it reverse a little bit. So you want to give an update on that trade?
Well, look, I mean, a lot of my setups are predicated on the idea that I see something where I know I can definitely get a little bit in the money, and the question is whether I get the follow through. That's a standard for my trading. It just skews the odds in your favor if you get good at short-term tape reads to kind of push things in your favor in the large sample where you're always going to get a little bit in the money, and the question is whether or not you get the follow through. And as we will discuss, and it's very pertinent to this show, there is just an extraordinary, I would say stunning, maybe even shocking amount of complacency that has gotten built into this market at this point. So
Yeah.
when you see bear setups at the index level where you know you're going to get a little bit in the money, over the course of a large sample size, that's going to pay off to take bets like that, even if you take a number of small little cuts and razor burns, because they're eventually one of these things is going to follow through in a big way.
Yeah.
So I'm going to be looking for a lot of these, I think, increasingly.
Yeah, I played one similar yesterday that we're talking about in the S&P that's set up, and I think it's always obvious for you what you're looking for by the amount of risk you would allow in your trades. And I think you had a 30-point risk on this Dow,
Which is tight.
which is
Without
extremely
yeah.
tight.
Yep.
Exactly. So,
But that's what I like. I like it on a pattern where my falsifiability level is narrow. How much risk you take, to me, is a function of the pattern and the situation. So we get a tight pattern like this. We've got a very clear battle at a very clear level. I see that
very
declining
clear
off.
upward trend, obviously,
Very
too.
clear upward trend. But so I know if it just breaks out of that a little bit to the upside, I don't want to be involved because it's resetting the pattern into something that's no longer constructive from the downside.
Right.
And when I see that as a tight point, I see the falsifiability level pinned closer and closer and closer to price. That's an advantage from a trading standpoint because it means I know I'm wrong sooner. And one of my most important tenets is you want to take setups where you assume you're going to be wrong and you want to lose as little as possible. So if you know that the setup is broken with a small amount of price movement, that's an advantage. That's an edge. So that's one of the other precepts of the type of patterns that I like to take because, again, this is about closing the door to big losses and opening the door to big gains. I mean, that's just basically your job.
Right, and you do it well. Obviously, you've been hitting some pretty big gainers over the last few years, and like you said, sometimes you got to take a couple little cuts, but those little cuts will quickly be erased once you do get that move to the downside. Obviously, we're in that environment though where it's a little bit like your bathtub analogy, right, Brett? Trying to push that ball underwater, and it's simply nearly impossible to.
That would be my swimming pool analogy.
Your swimming pool now.
The bathtub one is different. We can get into that if you want to, but the rubber ducky versus the beach ball.
So either way,
I gotta
Brett likes water in his analogies.
Yeah, I do actually quite a bit.
But I mean, when you're talking about liquidity, it's probably as good of a analogy as you could use.
Hey, very nice. Very nice.
So let's take a look then, Brett, at the overall market, and you can't take a look at the market without looking at the current sentiment. And we were talking last week about that bullish sentiment in the AAII data that was just saw that big jump to 56.9 on bullish sentiment, which was the highest in just about 3 years, if I recall. And since then, we did see it cool off just a little bit on this
Tiny.
morning's, to 53.8. So, down 3 basis points from 56.9 to the 53.8, or 300 basis points, I should say. And most of that, it seemed, did flow into the bears, because the neutral also came down from 22.7 to 21.6. And then we saw the bear data rise up to 24.6.
But let's just look at the 5-week moving averages of these data points.
Yeah.
They're all right in the same zone, and they're all in a bad place.
Right. I mean, they're all getting into extremes, which we've talked a lot about in the past.
On a 5-week trailing basis. So this is one of the things we've talked about with this data point before. When you start to see the 5-week moving average of these things, you start to see it fester in a place that's difficult. So we're seeing this pin. The bulls are pinned in an area where that shows there's a positioning function that's happening there. And this is a small sample, but it's representative. It's like a voting poll. And you can find out what a whole county is going to do by talking to 60 people if they're the right 60 people. And when you're looking at the entire market, you look at this type of survey, we're seeing 5-week moving averages get to extreme areas. So that means you've got this whole period of more than a month where people are feeling basically the same type of outlook, which means they're taking action on that, and that's building up. And we'll talk about some other data points that reinforce this idea, but there's a festering of vulnerability.
Do you know how many people are in this survey, Brett? I've never seen
500.
that number. 500, okay. So, all right. I mean, and obviously a fair sample of individual investors out there. They all have to be members of the American Association, right?
Yes.
Yeah. So, it's a data point that we continue to watch, and we're seeing that sentiment data play out in a couple other areas too, Brett. Taking a look at Sentiment Trader, we had a number of overly optimistic areas, and some of them we've been talking about for the last couple of shows, right? And that's in the options data. It's been pretty evident in the put-call ratio, and we've talked about the phenomenon there, where a lot of this is a function of new traders coming in and using the options in order to get leverage, and they've been doing it pretty well, really, for the last couple of months. But we did see the Lobo on this side too, Brett. So obviously,
real quick, I just something unusual right now. I just posted the table.
Okay.
So you can see it. I just want people to see the red boxes.
Right. Okay. So there
I don't typically do that, but if everybody wants to take a look at the page, so you can see the list of different things that we're looking at. This is just sort of my favorites from Sentiment Trader.
And I'll drop this in while we're having this discussion, so you should be able to see it on on our audio feed too. So this is what we're looking at here, and the 3 green dots, that means that it's overly pessimistic, and the red ones mean that they are overly optimistic. The general thought process being similar to what we were just talking to in the AAII, what Brett was mentioning, is positioning. If everybody's kind of feeling this way, if you're, say, looking at the bullish data, who's left to buy if everybody's bullish? And that's kind of the way we look at it. It's funny that the AAII bulls data has only got 2 marks here, Brett, but as we can see, it's certainly...
Well, the bull ratio, though, is glaring. And
right.
That's really, when you take the bears, and I don't know why the bears has no marks, because it really is right at where it should be. So the bears should really be in this. I mean, it really is. It's at an extreme, even though you don't see the automated 3 boxes from Sentiment Traders. So they really both are, and that's what shows up with the bull ratio. And again, we're talking about when you accumulate it over 5 weeks, they're there. So, and that's one input, but the options data is pinned hard. And the equity hedging index is another one right down at the bottom, where it basically takes 6 different measures of different types of hedging. There's just no hedging. And that doesn't necessarily mean the market has to go down. It just means this vulnerability is building up. And it reminds me a great deal of the market at this point that we saw in January of 2018. Maybe a month after the tax reform bill.
Just before Davos, when we were heading into there. And then Mnuchin made the comment about the dollar, and that's when we started seeing things kind of falter, and that
Well, we had the crash in
trade
the
war really.
inverse. We had the crash in the inverse VIX trade, and that was really what marked that big crash in the S&P. If
Right.
everybody remembers, SPXY just went to nothing, basically.
Which was a bet against volatility, but we saw the volatility pick up right around Mnuchin
Yeah.
in Davos.
Yeah, sure. But that was a sign of the complacency that was in the market, because
Right.
there was such an assumption of an impossibility of volatility. It was all kind of wrapped together following the tax reform bill, which basically meant there's no chance there's any risk for stocks. And that built itself in, and then you got the crash, which was 10%, I think, in 3 days.
Yeah, and again, obvious, and we got the Lobo, Robo, and option speculation. So, just to reiterate, Robo is the retail only options ratio. So we know that one would be on the extreme side, but the Lobo one, which is the large only, that is one that's recently crept up into there. Now, it's certainly been in the red, Brett, but are you kind of surprised that you're not seeing more protection being bought by some of the larger players there?
Well, it's just like the equity hedging index. Those two are saying basically the same thing. And
Right.
that's the complacency, and that's, the other side of complacency is vulnerability. It's the same coin. But yeah, when people start to think that they have to keep up, right? I mean, think about what hedging does. So if you're a fund manager and you believe that the environment is increasingly constructive, maybe you're a little bit worried that you're involved in a crowded trade. But the other side of that idea is that everybody you're competing with in your industry is, on basically full speed ahead. So if the market moves a little bit higher, they're going to increase their returns a great deal. If you're carrying a bunch of hedging, you're going to lag. So this is a game theory landscape that's skewed toward forcing people into increasing vulnerability when we start to get less perceived risk and the crowd starts to move. And the crowd, I mean the institutional crowd, starts to move toward just basically opening up complete exposure to upside so that they don't lose a step with carrying hedges. But that game theory landscape ultimately leads to those large downward moves that can come out of nowhere, because once you get to that tipping point, everybody has to scramble for protection.
Right. So I heard a comment today, better to get protection now while it's still cheap rather than be forced to when it's expensive, right? So
Sure.
just something that we'll be keeping an eye out on. You mentioned the equity hedging. Risk appetite obviously kind of falls all into that as well.
Hmm.
We mentioned the options numbers there, the AAI we've covered, mutual fund cash levels. Now, we will see in the fund manager survey that did come down a little bit, but still that was coming down from, I think, historical highs here. So you have any thoughts on that mutual cash fund number?
Now that 3 month lag, but it's been sitting there forever.
Right.
So the cash level is a little bit like what I just said about hedging. So if you are in a competitive industry, if you're carrying a bunch of cash right now, it's just money that's not doing anything for you. And if your industry and your competitors in your industry are taking all of their money and hooking it up to the system to extract the greatest possible returns for the period of time where the market is moving higher, and you're sitting there in 7% cash and everybody else is in 3.5% cash, then you're on a ticking clock for your career.
Yeah.
So I mean, it's really tough to sit there with a lot of cash or a lot of hedging in an environment like this if you're in the industry. And then we've also got the retail side, which is another factor. I mean, we could talk about that too, but one of the stunning data points to emerge recently in the last B of A flow show was the idea that over the last 5 months we've seen more inflows into equities than we have in the
12
last
years.
12 years combined.
Yeah,
So it's a different market, and that's the big difference between now and January of 2018, which was totally an institutional market. It was just a professionals only game. And now, I mean, obviously the landscape has changed completely into a retail driven bull market. So and that's an important difference, and it may mean it's an important difference in the type of moves that we can see to the downside if there's just going to constantly be this just flood of money coming into the stock market.
Right. And then the other two ratios in the extreme that we have, well, three, because we'll touch on last on that inverse ETF. The NYSE high-low ratio, which as everybody can see, is a measurement of breadth. What this generally means is that it's a little bit of a slimmer top that's leading this rally here, and that's always a little concerning because the idea is that it's a little bit easier to knock us off the perch, right, Brett, if some of those leaders had been running higher start faltering a little bit. And the other one
So
is the soft versus hard economic surprises. We've talked a lot about some of the strong PMI numbers. That just this morning we had the New York Empire and Philly Fed numbers. And as you can see, this soft versus hard economic surprises, that's from April 9th. So that didn't even take into account the nice beats that we saw on those two numbers. Did you have any thoughts? Did you have a chance to take a look at the Empire or Philly surveys?
Well, I mean, so my prediction is that so soft versus hard economic surprise, I think you can take it kind of out of the sample because it may be saying something very different. It could be bearish when it's in this state, but it could also be bullish. And in this case, I think we're probably going to see the hard data start to. It's a little bit like um, Q1 of this year is people are starting to really see clearly that we're going to see some really strong economic data in Q2 or Q3, and that's why you've had such trading flows, and that's why you see the banks doing so well in earnings. But that's also why you had this, such a soft data boom because people can really see around this corner pretty clearly. It's unusual the degree to which you can see around this corner right now. When you're talking about the vaccine rollout and the reopening of the economy and the huge stimulus bill and everything else, it's a historically abnormal moment for it to be so easy to be able to predict a pickup in economic activity, right? I mean, wouldn't you agree with that statement?
Yeah, yeah.
Yeah. So this data point typically has one meaning, and now it probably has a different meaning, which is you're going to see it move the other way without it necessarily implying that there's going to be pain. It's not necessarily the case that people are overly optimistic. It may normally mean that, but it's pretty easy to see that we're going to see a sharp pickup, particularly in comps data on the economic side, as we head into Q2 and Q3 of this year. So I don't know if that data point necessarily means the same thing it usually would. We're going to transition from it being the Philly Fed data being great to it being eventually, GDP data being great. And I
Yeah.
think that's a relatively predictable process.
All right. And then I did find this odd where there's one item that is in the overly pessimistic, and that's the inverse ETF volume. Do you think people are just kind of using that as a placeholder instead of put activity, Brett? How do you square that peg there?
So there's one possibility, and this is something that has been something I've done in the past as well, where you can, if you believe that the market is either going to go up or sideways, your most your least risky path to taking advantage of that is to short inverse ETFs
Right.
because there's a time decay to them.
Right.
So either the long or short side of an inverse ETF. So sometimes you have the triple leverage long and the triple leverage short of whatever, the Nasdaq or whatever. Like you have two sides to it. There's one of them is inverse and one of them is levered long. Both of them because of the leverage, and inversing is leverage because it's negative 1x as a coefficient. So any coefficient causes this problem in terms of mathematical decay. So um, you can short both of those and make money over time as long as you have deep enough pockets. And one strategy that hedge funds use quite a bit is to take advantage of that mathematical decay situation by using short inverse ETFs as a means of being long the market when there's the possibility of sideways chop, which also leads to increased decay. So they'll go down when the market goes sideways, and they'll go down when the market goes up. So you take two of three possible scenarios and put them in your favor, and it skews the math in your favor. I don't know if that's what's happening right now, but it's possible that that's leading to increased volume in some of these things. It is also possible that they're becoming part of some kind of arbitrage with options as a more nuanced version of hedging. But given the equity hedging index data, hedging seems to be conceptually pushed out of the equation right now. Otherwise, nothing that we're saying makes sense if there's a massive amount of hedging going on just in these in these instruments. So I'm not really sure, but I think it's possible that they're being used to speculate on the long side by increasing short interest, but I don't have the short interest data on them.
Right. And I guess the general takeaway when we're talking about the leverage, when we're talking about the lack of protection to the downside, it's kind of why Brett and I both are kind of probing around for those shorts because we know if this hits, and we started off the conversation talking about it, that there's the potential for it to really get going to the downside and be a pretty big winner. So it's not a bad way just to do a little bit of probing. The problem, of course, is trend and liquidity, right, Brett? That's uh, definitely been working against any shorts that at least that I put on.
Yeah, I mean it's a process.
All right, so the sentiment as we're well aware, and we'll talk a little bit more when we get into fund manager survey about it, but is extremely bullish. Let's take a quick glance at earnings, Brett. We're getting underway in earnest, obviously. A pretty good start to earnings season, but we haven't necessarily seen the type of reaction one would kind of hope for in some of these names. Outside of Goldman, feels like most people have been seeing a rollover following pretty strong results. I mean, the banks have just been fantastic throughout the way. We're seeing some of the reopening trades like a Delta post decent numbers, but showing great linearity improvements and also actually hitting cash flow positive. We saw United Health out earlier. They had a pretty good report. That seems to be one of the few names that's holding up. So curious as to your early take on earnings season and perhaps more importantly, the price action we're seeing to some strong numbers.
Right. So I mean, with the banks, um, one of the things that I wrote about in my notes this morning is the idea that the trading activity during Q1 picked up more than the economic activity did. So it's possible that we're starting this earnings season with the group that would have had the best first quarter relative to expectations, and a lot of the rest of earnings season is going to be more about what companies think their outlook maybe when you look at Q2 and Q3. So it's going to be more guidance driven rather than the banks, which is more results driven. And it's kind of simply like extrapolating the idea that markets are discount mechanisms and they're forward looking. So the boom that we're set up to see happens the rest of the year from here. But a lot of the trading activity was sucked forward into Q1 because, just like we talked about with the soft versus hard economic surprises, this was a historically unusually easy corner to see around. So markets have been going crazy and trading activity has been picking up, and we've seen those huge retail inflows, and that's all really kind of bread and butter for the banks. But at the same time, we've seen this strange kind of, I mean, I would say that people are looking at it as a counterintuitive move in the bond market over the last couple of weeks, and particularly today, which is something that, I mean, one of the things that was powering banks higher is net interest margin and the steepening yield curve. And if we're starting to see, let's say, the extrapolation view of where interest rates are going to be at the long end, if that's shifting because people are just assuming 2% is coming any day now, and suddenly that's not the case and we're headed toward 1.5%, that maybe changes the outlook when you talk about the rest of the year for the banks. But I'd like to hear your thoughts. I mean, do you think these reports were really that much better than you would have expected?
I was that much better than I would have expected. Probably not. I mean, there are certainly high expectations. Obviously, the IB units we've been talking about, the investment banking units, we've been talking about them for a few weeks ever since we got the Credit Suisse numbers a couple of weeks ago, and that was obviously pre-Archegos, but we also got the Jeffries figures, which is always a good inside read. That certainly predicted the Goldman Sachs and JP Morgans of the world would have some pretty impressive numbers. The reserve releases were somewhat expected. I think that they've probably been a little bit better than some people thought. And, we'll continue to keep an eye out on that. Hold on a second, sir. All right. Yeah, there we go. So, we'll continue to keep an eye out on some additional names coming out. We got Morgan Stanley tomorrow and the regionals, a lot more coming next week. But what that shows to me is that they just see the economy in a better place. And I definitely thought that was probably the most bullish thing that I've seen coming out from these names.
That's a really good point.
And but I think some people are disappointed with the lag in net interest income and net interest margin. But that always takes a while because if you think about it, you need portfolios to see maturities at some of these really low interest rates roll off the books. So it's usually a couple of quarter phenomenon when you start seeing rates rise. So maybe some people were disappointed in the net interest income and the net interest margin. And these banks have certainly been conservative with their outlooks going forward on it. So if I was looking for a smoking gun, I would say that would definitely be one of the things. We've also seen costs in a few areas on the rise as well. Now, the other thing that I would maybe point out for why we're seeing this little sell the news reaction despite these strong results is loans have been down. And that's going to be something I'm going to get into you with in a little bit, Brett, when we get into the fund managers survey, particularly with the push to get CIOs to spend on R&D and to build out, and we simply haven't seen that. We've seen the consumer spending, obviously, with the retail sales, but not as much with some of the businesses. Now, the question is it the businesses simply are not spending because they're waiting for an all clear on the vaccine, or are banks losing out to fintech and fintech getting a little bit more of the wins here, and that's really kind of biting into their loan growth, and that's something I think that could maybe be giving people pause.
And then should we be looking for that as like a later in the year story?
Which one?
Well, I mean, like when you really start to see the ramp. I mean, right now it's still spend? We're headed. Yeah, we're headed. I mean,
I completely agree that's a second half story, but I mean, the market's a forward-looking instrument, right? And they kind of had this priced in, and it's a small subsect, I would say, that's concerned about this, but that's where you see that little rattle. I mean, I would hardly say anybody's running for the hills in the markets by any stretch. Mm-hmm. We're just seeing a little bit of dip, and with the banks too. We've had such a strong run since the elections. A little bit of profit taking in the group. It shouldn't be all that surprising. And we've talked a lot about the first week of earnings in the past, Brett, where you never want to get too tied to, this is how earnings season's going to unfold, because we have seen head fakes during this week as banks start coming out. And, I never get overly concerned with how banks trade in the coming days after. You want to see the pattern develop. And if you were to look at banks, I think it's fair to say that in general, from reporting Q1 to Q2 to Q3, it's a longer-term trend that remains in play. You rarely see very choppy action coming from the banks. I'm sure if you looked at 2008, 2009, you would. But, for the most part, they're big animals that are trend directions. And does this pertain to maybe a downside trend? I don't think so. I think it's just a little blip on the radar, and we'll come back and see that, when we talk in the next Sentiment and Flow show.
I think that sounds about right.
But overall, their report card, as far as the economy goes, I'd give it an A. From the numbers that I'm seeing. So I'm not completely surprised by the action. And like you said, some of this was priced in, so a little bit of sell the news baked in for earnings.
Sure.
But we'll see what happens when we get next week into some of the bigger tech plays, of course. We get a few more energy names out there, some healthcare providers. Tomorrow will provide a little bit of a better mix for us when we get, just in the afternoon, we'll get Alcoa, JB Hunt. So, get some industrials in there, and the transports, of course. And then tomorrow, still pretty heavy on the bank side, but we will get KSU sprinkled in there too. So that'll help give us a little bit of direction there. But all right, Brett. So that's the earnings. So let's take a look at the fund manager survey here. And we're just going to run through a few of the items and some things that were jumping out to me. And Brett, obviously, if there's anything that I'm skipping over, definitely feel free. I mean, the obvious takeaway is that bullish sentiment remains pretty high. It was a little bit of a decline, I think you could argue, from last month's, but I mean, still at bullish extremes. Would you agree with that?
Say it again. Sorry.
Just in terms of the bullish sentiment, I would still say it's at pretty extreme levels. It feels like it did peter down just a slight amount from the March survey. That was kind of my overall general take on the data.
Yeah, no, absolutely. I mean, it was, I think that we are seeing, as I said right off the bat, I think that we're seeing a somewhat stunning level of complacency across the board. And I think that that's just introducing risk. You don't know whether it's necessarily going to be taken advantage of, but it's opening up the possibility. And it's one of the reasons why I think you and I both are kind of looking for opportunities to establish a position with defined risk where if you start to get a cascading move, or if some factor comes into the picture that hadn't really been positioned for, then you can take advantage, because the downside, when you don't have a lot of hedging, when you have a lot of complacency baked in, the downside is really about reestablishing protection, which is only done through one way, which is selling. So, I mean, when you don't have hedging in the market, any kind of unforeseen negative factor that gets involved in the picture, it has to result in selling. So it skews the risk reward ratio in the market tremendously.
Right. So one of the things from the sentiment that we were just talking about, Brett, is we're keeping an eye on tail risks, and always interested to see where people see the tail risk at. Now, the highest tail risk that we see is in the bond market, which is a taper tantrum. Now that was down from the prior from the prior month's sentiment. It came in right around 32%. Now, number two was inflation, which I think, we could kind of add those together, right, Brett? And that, again, though, was down to 27% from last month when was number one and running at the 36% level there. So let's take a quick look at the expectations, some of the inflation data that we've gotten, and today's action in the 10-year, which I think was one of the key items, and I'm curious to get your take on it, where we are seeing obviously some signs of rising inflation, certainly in the sentiment data. We got the hot PPI number last week, but CPI data, that came in generally in line with expectations. And we saw the import-export numbers come in generally in line with expectations, a little mixed there, but nothing that was really jumping off of the page for us here.
Well, I'd say there was expectations and there was expectations. Right?
Yeah,
like
no, that's
I think there was
fair.
an abnormally wide range of whisper fear on particularly CPI. Like there, at some point, there's going to be a freaky comp, right? And maybe we start to see it now, maybe we don't, but at some point we're going to be we're comparing to. It's like I said, like how if you see two people standing side by side, how tall is one person versus the other? Well, the other is standing in a deep hole. And we're going to gradually roll into this, the base effects picture. We're going to gradually roll into this comp outlook that's comparing to a historically extremely abnormal period from last year. And I think there's just this kind of sense that people won't process it well. People won't necessarily take into consideration. You're going to see these big prints and these really freaky comparative data points that are going to cause knee-jerk reactions to the market. And I think that people are starting to try to prey on that reaction.
Yeah. Well, I mean, that's certainly in play here. Now, obviously, we got 93% of FMS investors expecting higher inflation in the next 12 months, which was flat month over month, but it's still at all-time highs, kind of plays on what we're just talking about here. And above, the general has fallen into above trend growth and above trend inflation as well, which is a little bit different from the Goldilocks we're looking at. But I guess, Brett, when we saw the econ data today, were you surprised at the move in the 10-year?
So yeah, I guess well, so it's one of the reasons why I like to see how something moves, and I use the difference between the news and the movement to give me a sense of the market. And so immediately my post in my notes was, 10 years headed to 1.5. And since then it's really started to trend in that direction. But it shows you that there's some factor, there's positioning. So we knew there was a lot of bond future shorts, and I think we're at 1.58. When I said that we're at 1.53, I really should have just been buying the ZN or ZB. But we're obviously there was a counterintuitive reaction there. So I think you've got a couple things, but one of the main things I think is there's a lot of people short bond futures market, but there's also this relative yield situation when you look at foreign flows. And if you have confidence in that we're going to be able to deal with supply, and we put out a ton of supply over the last week, the market didn't really break, and we got that kind of less than feared sort of CPI number. Now we're past all of that. And I think that, you can get so much more of a return. People use a lot of leverage in sovereign wealth funds around the world, and they can borrow in their currency and buy in another debt. And the United States has a much higher yield. For instance, when you're looking at, like institutions in Japan, or across Europe, they're going to be taking their money, they're going to be borrowing in their currency, they're going to be buying our bonds, because you can get a guaranteed return there. If you do it on leverage, you can make a lot of money. As long as you don't think that everything is just going to suddenly break, just shatter in terms of the trend in the United States bond market, because you don't take that capital gains loss. You could just look at the relative differential in interest rates. So when we start to hold up against something like that CPI number, we start to hold up against some of these bond auctions, and the bond auctions really don't look that bad, so the supply is not going to be that much of an issue. I think you're just in a ripe situation to start to look for people to leverage up on that relative yield differential in terms of foreign money flows. I think that's one of probably the main things that we're seeing, and that's exploiting the short interest situation in the ZN and the ZB, and we're getting just piling on right now. But if you look at a long-term chart,
under that philosophy, Brett, I'd be curious, is some of the recent bond auctions, the indirect bidding seemed to be running a little bit lighter than expected. So are you surprised that the indirect bidding's been lower then under that philosophy? I would think that it would be much higher.
no, because I think that's a really complicated data point to untangle. And I
Okay.
think there could be a lot of ways that it could appear one way and be another, because there's a lot of complicated ways that people can manage that. But I think that the yield differential makes it easy to see the opportunity there, especially when the trend has slowed down or the momentum is not there, because that's really the only risk that you take is the hedging risk. And also the currency volatility. And we're not seeing a runaway move we're back in kind of a range-bound currency landscape, which means your currency hedging factors aren't going to be that much of an issue. So it makes it easier to manage that kind of position. I think it's too easy conceptually to see. I understand you can look at an objective data point, but that objective data point may not mean exactly what you think it does.
What about the action in the Dixie then? Would you expect that to be higher? I mean, that's getting rejected here at the 200. It is showing signs of holding the 50 right around this 91.60 area. Or do you think that's a little bit of a one-off, just given the amount of potential issuance coming down the road?
Well, I think that it was moving higher when rates were moving higher.
Yeah.
I mean, yeah. So I think that's at the point where rates start moving back lower. I think that it kind of reduces that. Plus, I'm seeing a lot of different people saying that the vaccination rate across Europe through the months of May, June, and July is supposed to be gargantuan. And as an easy corner to look around, speaking of moments where it's easy to look around a corner, the data on that may be really easy to see because you have a schedule of massive orders. So suddenly the whole dam is breaking in terms of Europe's access to the vaccine in a very predictable way. And I think that's probably another factor.
All right. What would you be following in this move in yields that would, raise concern for you or kind of give you the all clear on the bullish side? Is there any particular action?
Well, I mean, I think you could just look at a weekly chart of the 10-year. I think that there's really easy technicals here. So you can look at just kind of back. There's a really powerful shelf under 1.5 or around 1.5%. And when we broke up through it, the market, that was the bond market crashing period. And you've got huge levels that go back to like 2012 that it's been 3 or 4 times tested, and we broke up through it. In my experience, when you break up through a threshold like that, you're going to retest those key levels. So that's one of the reasons why I said once you get this dynamic in play where you get a counterintuitive move, that means it's going to be tough for people to hold in the face of it. And we're probably headed right back to that level, which means 1.48, 1.49. But I think you can just look at long-term technicals and kind of get a sense of things. But I think longer term, I think that this is a consolidation in the course of a continuing trend.
All right. Here was an interesting thing, keeping with the yield. 6 to 10 investors say short rate rise, say they expect a short rate rise in the next 12 months. So it'd be the highest since January 2019. Do you read anything into that? And do you think that could have something to do with maybe expecting the Fed to start buying on the long end of the curve, perhaps?
So say which exhibit are you talking about?
That would be, hold on, let me see. It should be right near the top. Hold on, sorry. So that would have been, sorry.
Well, just say it again. Say it again. I can
Yeah, 6 to 10 investors say short rate rise the next 12 months.
Oh, yeah, sure. Yeah, right.
Short end of the curve. It's the third bullet point down there.
Yeah, no, right. Sure. And I think that I was looking at that as well. So the question in my mind is that saying that most people think that the Fed is going to change their dots? Right? I mean, isn't that really
Yeah,
what that gets to? In a way, and so you look at so we talked about euro dollar futures last time, which basically are the price of dollars outside of the United States. Euro in this context doesn't mean Europe or Europe related. It just means outside of. The word euro means outside of. So outside of the United States, what is the cost of dollars? And you can use that to understand predictions about what Federal Reserve policy is going to be. So you look at the forward curve in the euro dollar futures market to get a sense of where markets are pricing Fed's earliest action. And that is it makes a mockery of where the Fed's dots are at this point. And we talked about this a little bit last time, but now it's more dramatic. So at this point, the euro dollar futures market says that we'll be at 2 hikes by December of next year. And it says we'll be at 5 hikes by early 2024. And right now, according to the Fed's dots, they're not going to hike at all until 2024. Isn't that right?
Yeah.
So we're talking 2 years ahead of that, we're going to be 2 hikes in. And by the time we get to the Fed's timeline, we're going to be 5 hikes in. That's what the market is pricing right now. And I think that you can take a look at a lot of these data points in the Fed Fund Managers Survey, including, so I'm not sure what the time frame is for the question that was asked in this survey. It's just, do you think short rates are moving higher? There's a lot of people who do. Are they saying really in the next year, or I'm not really sure. But that would suggest, that there's, just like taper tantrum fear is the biggest fear, moving higher in short rates. This all suggests that there is a gradual breakdown in confidence among large fund managers that the Fed is going to stick to what it's promised. I think that's where you can boil it down that way. You look at euro dollars, you look at the results of the survey, that it's just a matter of time before the Fed starts to say, okay. We didn't really mean it when we said we were going to wait forever no matter what the data was.
Right.
I think that's really what all of that means. And so what the consequences are of that, there's a lot of different consequences of that. I mean, when you talk about, are we going to continue just steepening the yield curve as growth accelerates? What's really the timeline for peak data in the cycle? I mean, where are we going to start to see the peak possible growth here? Because you can look at it like the Fed's going to stick till 2024 no matter what's going on. The upside's unlimited, but really If that's just a game they're playing with language, which I suppose is the point here, then really peak cycle growth is a lot earlier than that.
Okay. And keeping an eye out on the rates here, the next item, Exhibit 12, Brett. Um, the question was, at what level do you see the 10-year getting to that would make it a reckoning for stocks, meaning bonds would perhaps get a little bit more interesting than stocks? And nobody voted for 1.5%, but the funny thing is the highest response was for 2%, Brett, where 47% of investors thought there might be a reckoning for equities if bonds got up to that. Obviously, this pullback here to 1.5 makes it easier. Number two was the 1.75 level, which
we've already been to.
Which we've already been to, and we saw a little bit of a little bit of fluctuation certainly for stocks, but overall a settling there, and that had jumped ahead of what was number two in the last quarter, and that was 2.25, which dropped off a little bit to 18% from 19%. But that's certainly the levels that people are keeping an eye out on. So any thoughts on that and the action that we've seen here?
Well, I mean, I think that flip is just seeing the market stumble a little bit when we got to 1.75. And I don't know how much this means. I mean, 2% is just this giant round number.
Right.
And you just sort of seeing people kind of glom around what the most obvious answer is. I would imagine if there was a subsidiary data point, which was what is your confidence in your answer to this, this would be lower than most.
Right. And then the number, it seemed that where people would start pouring into treasuries over stocks seems to be about that 2.5% area, which came in right around 37. So again, I'm sure the Fed is pretty happy that we're seeing this pullback. And for now, it doesn't look to be a major issue. And I think, Brett, it's always about how we get to that 2% rather than the 2% number, right?
Very much. Very good point. If we get there in a day, you got it right there. That's a problem.
Yeah, exactly.
But if we go really slowly, if the frog, is in the pot and it goes up 1 degree an hour, then he's going to boil and never know it.
Right. So, okay, let's take a look at it. We'll just do a little bit of a speed round here, Brett, on some other items. One thing that I did want to touch upon is we've talked about this in the past, and that is the number of investors, what investors want CEOs to do with their money, and that is to increase CapEx, which is now at 54%, as opposed to paying down the balance sheet or doing capital returns. And we've heard that is where escape velocity would come into play. However, this kind of goes back to our early comment where business investment seems to be really trailing the consumer there. Recent data on consumer mixed estimates for Q1 of 2020 with non-residential investment declining modestly in recent weeks. I'm sorry, this is for the business. This is according to the Atlanta Fed forecast for investment in equipment, which has dropped from 23.5% to 14.5% since February. That's a pretty big decline from the Atlanta Fed forecast in business investment. Business investment was slumping prior to the pandemic, and it remains unclear if it will recover after the pandemic spend. We also saw in the Fed's April Beige Book, which was released just yesterday, that they were seeing some signs of this demand coming back, but of course shortages on the supply disruption has been a little bit of a concern. What do you think of this hint of weaker investment data? Do you think it could be short-lived with the Atlanta Fed analysis and that we'll see that return? Or do you think that that's something that could be a cause for concern that maybe people aren't really pricing in when we're looking for reasons to get a little bit more cautious?
So a couple things. So number one, I noticed that this is the highest since January 2018, which we've already talked about similarities with that period. So in other words, when you see when it's really easy to see around a corner, or at least it seems really easy to see around a corner, and people are really, really confident in a coming period of increasing economic activity, then you're going to see this data point go up a lot, right? It's the same reason why yields were moving higher in long end, because everybody wants to be a borrower and not a lender, because you can see that there's going to be a return to investment in the near future. So obviously people are going to want the companies that they've invested their money in or that they work for to make an investment, because there will be a return. You can see very clearly that that's the equation. So it's not a surprising data point. But at the same time, if I have a hard time seeing that it won't happen. And part of that is just, and I don't know, this is just really looking. So the same reason why we were really bullish on commodities 6 or 8 months ago. We saw a situation where now there wasn't a lot of investment going in. Obviously, that means the prices will go up. But then the other side of that coin is when the prices go up, there's going to be a very direct, traditional, economic, theoretical foundation for people investing in producing more commodities, right? That's how it works. Supply goes up after price goes up, because obviously it's more profitable to produce more commodities at that point. But it works in outside of commodities too. If you get a situation where you've gone a long period of time, so when economic expectations were very low, if we go back a year ago, there was obviously people just wanted to repair balance sheets. One of the reasons why we have a supply chain problem right now is because we went a period of time where people weren't, investing in the ability to move goods around because they didn't have the economic confidence to do so, because we were right in the middle of the pandemic. So when you start to come out of that and growth is limited seemingly by supply chain issues in a lot of ways, when you look over the next several quarters, I would think you have more money, you have favorable borrowing terms, you have a lot of government support, and you have people who want you to do more CapEx spending. And CapEx spending, I would think, and this is, I guess the question is, does it directly translate into solving some of these logistical issues? I would think that that's going to be a matter of CapEx spending. If that's the case, it seems like it's going to happen. It's hard to imagine that you wouldn't start to see a lot of investment, given that we're coming out at the other side of the process that we've been through for the last year. And one of the defining aspects of that process is a lack of that kind of investment, and that's a limiting factor, a clear and obvious central limiting factor to generating more growth. Does that make sense?
Yeah, no, it does. It does. All right, Brett. Last thing we'll touch upon here is some of the rotation that we're seeing, and I know we're getting a couple of feedback questions on it. So I'm just going to run through a couple of things, and then we'll just circle back around. But the April Fund Manager Survey did show a modest rotation to tech, healthcare, and REITs out of emerging markets and staples. More broadly, investors positioned for boom via long equity, commodity, cyclical allocations. And optimism is coming out of the emerging markets. I did find that interesting, actually. Emerging markets has given way to the S&P now as the top play for 2021 by investors. Emerging markets had been the leader in the clubhouse for the first couple of surveys that we're seeing. That is no longer the case, and we've seen.
I think for pretty obvious reasons, by the way.
Yeah.
I mean, I would say that's a function of vaccine distribution.
Yeah, a trail there. But again, it's interesting that you're just talking about where Europe's expected to hit kind of a high level of that vaccine. And
we're seeing the euro rally.
Right. So, it's something for us to keep an eye out on. With that cyclical rotation, we did see distribution of banks near its highest levels in a number of years. So again, that kind of points to some of the sell the news that we were seeing coming out here. Now, here's an interesting one. 24% of fund manager survey investors think small cap will outperform large cap in the next 12 months. However, this is down from 41% in January. So I think we've certainly seen that action play out. And I've seen you comment a number of times on the IWM. So do you have any thoughts on why this might be occurring? Do you think this was basically a sell the news around the infrastructure plan, or is there anything that's sticking out to you on that rotation?
Yeah, I mean, it's been a really curious dynamic, and I could think in terms of like global growth, maybe. I mean, a lot of times you look at something like, U.S. small caps as performing well when you're going to have a large disparity in favor of the United States. This goes a little bit against what we just said about vaccine distribution and the emerging markets, though, so I'm not really sure that's a good answer. Also, I mean, these small caps ran in an insane way over the course of a few months in the fall, and it may be just simply a case that they went too parabolic and they're in a consolidation, or it may be a real warning sign. I don't really know. They do tend to do better when the dollar is moving higher. The dollar's been correcting. There's a lot of different angles I could put on this. Truth of the matter is, I don't really know. I look at it just like I looked at when we talked about how the bond market performed today after the retail sales data. I may not be able to explain it, but I notice it, and it makes me a little bit. It makes it easier for me to start maybe taking some shots on the short side in general, because it's a little bit of a wrong note in the song here.
Right, and kind of a follow on that, 53% of fund managers now think that value will outperform growth in the next 12 months. That doesn't really play in with the small cap falling off, but it does show the expectations for growth to come up. Do you think? And I guess that survey there would have come right before that drop in yields. Do you think if we continue to see yields decline, that we're going to see a big reversal in those in the May fund manager survey?
Yeah, I think that's exactly right. I think that you've got this sort of, we've talked about the kind of, if you look at discounted cash flow model evaluating things, and you look at companies where you're basically saying, what's going to be really, this I'm investing in something because of the amazing revenues that are coming in 2025 or 2030. Any stock where you feel that way about it is going to fare poorly in a rising interest rate environment. And companies that are showing the cash right now are going to start to win. And a lot of times that kind of ends up being something that's very much parallel to the growth versus value argument. And we've seen the rotation into value versus growth as we've seen the yield curve steepen and as we've seen the long end rates march. Now, exactly right. We're seeing a reversal in rates. If this reversal in rates sticks around for another couple of weeks, then I think you're going to see a reversal in this data point in the next survey.
All right. And then just a couple of quick points from the April 9th Bank of America flow show. Weekly flows were $22.7 billion to cash, and we did see that cash number come down a little bit for the fund manager survey. $17 billion to bonds and $15.6 billion to stocks, $0.5 billion out of gold. We talked about that 5-month number where we've had more inflows in stocks in the past 5 months than the prior 12 years, which is just bonkers. $576 billion the last 5 months compared to $452 billion in the prior 12 years.
Now, there's I will say one caveat to that data point, if you think it through a little further, is that there are periods where we've seen over the last 12 years where we keep the whole year with outflows. So it's a net number. It's not like this is always positive. It's been so much more positive right now. I mean, part of it is that we've had nothing positive. There may be 6-month stretches somewhere in the last 12 years that have been similar to this one, but it's been canceled out by periods of outflows.
Yeah. Right.
But still, it's striking. I'm not saying it's not striking. I'm just saying
it highlights the seller strike that's on and why it's been so difficult.
It's one way.
Got that feeling that nobody wants to leave the dance floor.
Yeah, and the retail, we've got an excitement among retail investors for the first time since maybe 1999.
All right. And then there's a few charts from that flow show that I thought was interesting. Just like your thoughts on it. Nasdaq versus S&P. They noted that if the Nasdaq fails to make a new high versus the SPX, then that confirms the inflation rotation. Would you agree with that?
If the Nasdaq, say it again. If the Nasdaq fails to make,
if the Nasdaq,
in other words, if there's a divergence in favor of the S&P.
Correct.
Yeah, I don't know.
Yeah.
I mean, I guess because you're taking. What's the difference between the two? The difference between the two is energies and financials in a lot of ways.
Right.
So, yeah.
Yeah, because I mean, it takes such a large proportion of the S&P.
The mega caps are all in the S&P as well. So
right.
I mean, It's not perfect.
Well, then this one might be a little bit more interesting. Nasdaq versus the Russell 2000. They say if the Nasdaq does make new highs versus the SPX, then the Russell is in trouble. Would you agree with that?
Nasdaq makes new highs versus the SPX, then the Russell is in trouble. I guess.
Yeah. Okay. Okay. I was just curious on that. I wasn't sure what to make of it myself. So, all right. Well, I think that's going to do it for us, Brett. We're running up on just about an hour here. I apologize for the technical difficulties on my end at the start of it here, but for my take from it is we're obviously in a very bullish market right now. Sentiment is at extremes. Nobody's really looking at some downside protection. And this has worked for the last couple of months, so it's tough to argue with that outlook. But I do think that from time to time, you've got to kind of keep an eye out on potential downside activity there just to see if you can't get that pocket of a little bit of a correction. And I mean, at this point, Brett, we could have a 10% correction, and I don't think it would be all that big of a deal, right? That would just bring us kind of down to that 3,700 level around the February lows. I mean, we haven't gotten anywhere close to.
I think it depends on who you ask.
Saying it depends on who you ask in what context.
Because there's a whole lot of people who own a whole lot of calls. So yeah. Some people think it's a really big deal. I mean, that's the point too.
Right.
A tiny move is going to be felt more powerfully by more people than under typical circumstances because of some of the stuff that we posted in that table. If you've got so many options ratios that are so skewed, there's a lot of leverage. There's a lot of derivative leverage. 10% is 1,000,000,000% to somebody who's jacked up on derivatives right now.
Right. But at the same time, those flows show, as we were just talking, that people aren't walking away. So, we'll have to keep an eye out to see what that event's going to be that gets people out of the way. Is it some sort of black swan geopolitical event? We don't know. But my main takeaway, Brett, from our conversation is that I remain bullish. I mean, the economic data is there for the second half and everything, but it would not surprise me to see a hiccup along the way in the next couple of months. So that's what I'm watching out for. What's your big takeaways?
So I remain long the market in an unleveraged portfolio and looking for opportunities to short the market in a leveraged way. So exaggerated, sharp, short-term downward move is becoming more likely in the course of a trend that's probably still has some room to run.
All right. Well, that's going to do it for this episode of the Sentiment and Flow Show. I know that there's been a number of feedback questions. We'll circle back around and get to them if we promise and take a look. But for now, Brett, as always, great talking to you. It's always a fun time. Thanks for joining us.
You got it. Thanks, Gav.
All right. We'll talk to you soon.
All righty.